March 26, 2021, Wall Street witnessed something shocking. Within about 48 hours, a private investment firm triggered more than $100 billion worth of stock sales across global markets. Several major banks lost billions of dollars, and one man's fortune collapsed almost overnight. That man was Bill Hwang, and the firm at the center of the disaster was Archegos Capital Management. Welcome to Real Cash Case, where we break down the real financial stories behind the biggest money disasters in history. Bill Hwang founded Archegos in 2013 after shutting down his earlier hedge fund, Tiger Asia. Archegos was structured as a family office, meaning it managed mainly Hwang's personal wealth instead of outside investors' money. Because of this structure, it faced less public disclosure than hedge funds, allowing its trading activity to stay largely hidden. But the real story begins with leverage. Archegos used financial contracts known as total return swaps. Through these agreements, large banks such as Credit Suisse, Nomura Holdings, and Goldman Sachs bought stocks on Archegos' behalf, while Archegos took the profits or losses. This arrangement allowed Archegos to control massive stock positions without publicly appearing as the owner. By early 2021, the firm had built extremely concentrated positions in a small number of companies. These included Viacom CBS, Discovery Inc., Baidu, and Tencent Music Entertainment. Analysts later estimated that Archegos had exposure of more than $50 billion in stocks, despite having far less actual capital. Here's why that matters. When an investor uses borrowed money to buy stocks, falling prices can trigger something called a margin call. This is when banks demand additional money to secure the loan. In March 2021, Viacom CBS announced a large share offering to raise capital. The news caused its stock price to fall sharply after a huge rally earlier that year. That drop triggered margin calls from the banks financing Archegos' trades. Bill Hwang couldn't provide enough cash to cover the losses. Once that happened, banks began selling the shares connected to Archegos' positions. The result was one of the fastest sell-offs in modern market history. On March 26th, massive blocks of stock were dumped onto the market. Some single trades were worth billions of dollars. Within 2 days, Credit Suisse lost about $5.5 billion. Nomura lost around $2.9 billion. Bill Hwang's personal wealth, once estimated at around $20 billion, was largely wiped out, all because a highly leveraged strategy worked perfectly until the market moved the other way.